Okay, class. So this is the second video for chapter 1, and it's going to be a little bit shorter because that first video was really pretty long, but it was a good video and it was important. So we're looking at this video. It says selected accounts on this Consulting Incorporated financial service business have the following balances at the end of the first year of its operations. The stockholders bought $27,000 of stock in the business. So I'll click here on this data table and it gives us this list of different accounts. Now we're just starting out, so our goal is we want to be able to classify these accounts. Okay, now I'll tell you up front, an asset is going to be a resource of the business. And initially, it'll be relatively obvious what the assets are. Liabilities are what the company owes. And typically, liabilities will say the word payable next to them, or they'll say liability. The only exception to that is unearned revenue, but for the most part, liabilities say payable. And then revenues, which are in the beginning, just say revenue, and expenses that say expenses. So the first thing we're going to do is identify each of these as being an asset, a liability, a revenue, or an expense. Okay, so as you can see, I went ahead and filled in the categories, and what I want you to see is the pattern. Office furniture, it's a resource of the business, okay? Accounts receivable. Now that's one you may not have seen before. That's what customers owe you. That's an asset. Notice that the expenses are always expenses. The payables are always liabilities. The revenues are always revenue. So the only ones you have to look a little bit closer at is maybe the assets right now. Office supplies, asset, salaries payable. So just kind of go through and see that there's a pattern, and it's easy to classify accounts. Later on, when we get into chapter 2, I'll show you a couple exceptions, but other than what you see right here, this is the norm. Now, second, it says that we're going to create an income statement. And an income statement starts with the name of the company. So this is the Annis Consulting Incorporated. It's an income statement, and income statements are for a year ended. Okay, they're not on a specific date like you have for a balance sheet, but are for the year ended or for a period of time. Okay, now the nice thing about a income statement is it's just basically all of the revenues minus all of the expenses gives you what the net income is. And so we look over here at what our revenues are, and we put in that, and then we'll subtract our expenses. Okay, so class, I just simply took the information from the data table, and just a little bit of information is financial accounting basically takes data and it turns it into information. And some of the main information that you give external users of the information are the financial statements, the income statement, statement of retained earnings, the balance sheet, and the cash flow statement. So we're back to the income statement, and all the things that said revenue, which there was one, we put into the revenue. Then we listed all the expenses. Now for this chapter and for most of the chapters, we list the expenses by the highest expense to the lowest expense. And all we did was just go through and take each one expense, salaries expense, rent expense, the property tax expense, and we listed them. We added all the total expenses up and we subtracted it from the revenue. Okay, so that's what an income statement looks like. And that's something that you'll do throughout the entire year. So net result operations, we have net income of $41,200. Okay, so that gets you right into the crux of what financial accounting is about. And like I said earlier, it gets you there really quickly. Okay, chapter 1 starts right off. Now the next thing says requirement 3. We're going to create a retained earnings statement that's going to have a balance at the end of $36,200, and it wants us to tell them then what is the dividends. So this is the first year of our business. So first of all, we'll put in for retained earnings, we'll put in the heading, which will be the statement of retained earnings. This also is for the year ended December 31st. So our heading looks like this. And then we'll put in the amounts. Now, so the retained earnings at the beginning of the year, which is December 31st, 2015, or you could say January 1st, 2016, we're going to add the net income. And the reason we did the income statement first is so the retained earnings makes it so you have to do net income first. We have to put in, it was our first year of business, so we started with 0 in retained earnings, so 41,200, less the amount of dividends that we have. Now, sometimes in accounting, it asks you to do these little like numbers game. It's an equation. And it's telling us, okay, well, we don't know what the dividends are, but we know the ending retained earnings is 36,200. So this is like a algebraic equation. 0 plus 41,200 equals 41,200 minus x equals 36,200. So if I was going to calculate this using the calculator, I would go over here. I would say 41,200 minus x, which if you put it in algebraic form will turn out to be the same thing as minus 36,200. And so it tells me that my dividends are $5,000. And in the case here, because it says less over here, I don't have to put a minus sign. That would be the dividends. So I have an income statement, a statement of retained earnings. Check my answer. And unlike the last time where I said next question, I'll just say good job. And so this shows you we did a very quickly into categorizing different accounts, doing an income statement, taking the information, the revenue and expenses from the data table, and doing a retained earnings statement where we actually did a calculation to determine the amount of dividends. Okay, so that's the second problem for chapter 1 that we're going to be doing, and I'll be talking to you soon.